In today's video, I am going to be breaking down the ETF QYLD. It's a Global X NASDAQ 100 covered call. Now, this one's actually quite interesting, and I'm going to show you a way on how you can actually play this ETF. It's not something I would hold long term, and I'm going to get into that as well. So let's get down, let's check this out. Okay, so the yield is an outstanding 11.73%. So for every $100 you put into this ETF, you are going to get paid handsomely. That is, for every $100, you are going to make back $11 roughly and 73 cents every single year. So that is huge. That is massive. This is a huge dividend ETF. However, this is not one that you're going to want to hold for a long term. I'm going to explain that a bit later. Really quickly, its volume is huge. 1.7 million shares on average is nothing to be shy about. 0.6% expense ratio is a bit high when it comes to ETFs, so for every $100 that you put into this ETF, it's going to cost you about 60 cents per year. Of course, if you only hold it for a couple of months, you just basically are paying 5 cents a month essentially, so it's not that bad. Now, as we can see, it does pay a lot of dividends, and it pays dividends every single month. We're going to get into that in my next couple of slides, but as we can see, there is a negative history on this ETF. Now, why do I say that you don't want to hold it long term? Well, let me explain. When you are buying a covered call strategy, and of course, every single company that runs a covered call strategy does it slightly different. And when you're running a covered call strategy, basically, let's say you have 100 shares. So you're buying into this ETF, and let's say the ETF has 100 shares of Apple as an example. Well, they can run a covered call, which means that they sell a call that promises those 100 shares of Apple to somebody else as long as those 100 shares, let's say, for example, hit $400 a share. The stock price, let's say, is currently at, let's say, $380. Now, I'm not too sure how far out of the money that this company is doing the covered calls, but with BMO, they tend to do it way out of the money. That's why their covered calls tend to go up in value, their underlying equity, while other companies don't tend to see that happen. And if, for example, those 100 shares on that covered call don't hit that $400 strike price, that means that the ETF gets to keep whatever the premium for that call option was. Let's say, for example, it was $10. They get to keep that $10 for that 100 shares, and that's how you're getting paid out in the dividend. However, if it does hit that $400 strike price, that now means that those 100 shares were actually sold at $380 to the guy promised to get them at $400. So basically, your shares are now worth $380 and not $400, which means that your actual price of the ETF goes down because you just lost those 100 shares. You did make a little bit back on the premium, but that's going to be paid out as a dividend, and you will not be recovering the share loss between those two. However, this is why I say that you should not be holding this one long term. The NASDAQ historically has been a very big high flyer, which is why you see it go down during times where it's actually been going up, which is kind of curious for some people. And while it's been going down, this covered call ETF tends to go up, which is interesting. Until recently, since COVID, it's been going up no matter what, probably because it's been going up so damn high that it's just going to go up anyways. So how I would personally play this is anytime that you see on the news on CNBC that, oh my God, it's the end of the world for the NASDAQ, it's going down to zero, or whatever they say, it's going to be cut 30%. that is when you start buying. And as soon as they start saying, hey, it's recovering, the Nasdaq's doing great, sell, 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 get out of this ETF, because now you've been making that income while it's been slightly going down. You don't want it to be tanking like it did here. That's going to happen, but you generally want to buy it when it starts bottoming out, or just buy a little bit at a time on the way down. And then as soon as it starts going up, you just hold on to it for a bit, collect those dividends, and then as soon as you start seeing another downturn in this ETF, I would get out, get into something else. This would be an ETF strategy that I would really only be holding on to for about a year, maybe 6 months, collect that dividend, and then reinvest that dividend in other ETFs or other stocks, and then make your money on this ETF and get out. Wait for it to go down again, buy back in, and you can play that game every 6 months to a year with this ETF. Now, there are easier ways to really make money. You don't have to be active in the stock market. You could literally just stick your money in SPY and get no dividend, but you'll be at least mirroring the market. You could get something like a ZWK, ZWC, or whatever, and you can really just get a higher dividend of 7-ish%, which isn't anywhere close to 11, but at least you can get 7%, let it sit there, and until the market really rocket ships up, you're not going to have to worry all that much. So that's why there's different strategies for different people. Now, this ETF currently holds some of the biggest companies in the world. It has Apple, Microsoft, Amazon, Tesla, Facebook, the Googles, Nvidia, PayPal, Comcast, some of the biggest companies literally in the United States, but also the world. Now, they do pay a pretty darn good dividend, as you already know, and how I like to look at ETFs, especially covered call ETFs, is the actual dividend going higher, especially when it seems to be a basically random number that they keep on throwing at you. So when we compare January to, let's say, January year over year, you're going from 20 cents a share to 23 cents a share. That's looking good. My birthday is in June, so you want to look at June. And of course, no June yet, but let's look at April, for example. April, 20 cents to 23 cents now. Seems to be increasing in price, which is what I like to see. I hope that this video has helped you be able to have maybe a new strategy, or just even learn about this ETF. If it has, hit that like button, subscribe. Make sure to go check out all of my favorite books down in the description below. But also, remember not to listen to any random guy on the internet. You don't know if he's trying to push a certain ETF so he can sell out or whatever. So, of course, do your own research and see what works for you. Contact quality professionals, and I'll see you guys again next time.